Welcome to Morningstar. I'm Holly Black. With me is Tancrede Fulop. He's a Morningstar analyst in Amsterdam. Hello.
Hello, Holly. Thanks for having me.
So, Tancrede, you've been doing some investigation on the utilities sector in Europe. How have these stocks held up so far this year?
Pretty well. So European utilities are flat year to date, whereas the broad market is down by around 10%.
And one reason that a lot of people like these stocks is that they pay dividends, but we've seen a lot of dividend cuts across the board amid the coronavirus pandemic. So what is the outlook for the payouts for these firms?
Yes, as you mentioned, there was a wave of dividend cuts back in March, which caught investors off guard. 5 companies cut or canceled their dividends, including the 4 French utilities. But besides them, going forward, we see a limited risk of dividend cuts. We distinguish 3 groups of utilities dividend-wise. So the ones who cut their dividend, the 5 ones, we call them the ugly group. Then there is a bad group of 3 companies which issued cautious comments on dividends without cutting them yet. And then the group, which is the biggest group that we call the good group, is made of 9 companies which maintained and reiterated their dividend and dividend plans. So 9 companies, and for them, besides 1 company, which is Naturgy, we think that dividend is mostly safe because it's covered by free cash flow and by earnings growth.
Okay, so we have the good, the bad, and the ugly. Should we talk about a couple of the stocks that you particularly like in the good group?
Yes, sure. So I like Enel. It's in 3-star territory now, so slightly overvalued, but not significantly. You have a dividend yield of close to 5%. Importantly, there is dividend floor through 2022, which guarantees annual dividend growth of around 6% and going even beyond 2022, so 2024. I expect annual dividend growth 6% in line with EPS growth because the company has good positioning in renewables and in regulated networks. Another with a yield close to 5%. Another one that I like is RWE. So you have a lower dividend yield of 3%, but the stock is undervalued by around 15%. Following its the asset swap with E.ON, the group is now a renewables leader, the second global leader in offshore wind. So that provides visibility on cash flows and on dividends. I expect 7% annual growth in dividends to 2024.
Okay, so moving away from the good group, what are some of the stocks that you are not particularly keen on right now?
So within the bad group, there is National Grid. I think they will have at some point to reduce their dividend, to rebase it, to maintain their current investment grade credit rating. Now they have to maintain their dividend. They use a scrip dividend, scrip scheme, which is dilutive. But even with the scrip, I expect by maintaining the current dividend policy of growth basically in line with inflation, it will be too much to keep their credit rating. So to avoid downgrade and protect their credit rating, they will have to cut their dividend around 2022. And the cut is not priced in because the dividend yield is around 4-5%.
Tancrede, thank you so much for your time. For Morningstar, I'm Holly Black.